Well, results also out from Liberty Holdings this morning show a big turnaround in profits from a year ago, with the group's BEE normalized headline earnings a share rising from a loss of 422 cents a year ago to a positive 351.9 cents for the 6 months to June. With more, I'm joined by CEO Bruce Hemphill. Bruce, thanks very much for coming in today. Bruce, a big turnaround, but really a stabilized situation rather than a strong performance. Would you agree with that?
Yeah, I think that's right. I mean, I think we said this time last year that we needed to stabilise the business, and that always was the intention, and I think the management team has been able to do that.
Just perhaps outline what has actually turned around, what's changed over the last year?
I think there are two big things that have changed, and the first is that we recognised that we had quite significant deterioration in our lapse assumptions, our lapse experience relative to assumptions, should I say, and we had to put in place a program to correct that. And we have seen a dramatic turnaround in our lapse experience. So on risk business, we've seen a 27% improvement, and on investment business and retirement business, we've seen a 7% improvement. And overall, we're tracking ahead of where we thought we'd be this time last year. And on risk business, in fact, we're now below our lapse experience is now below the long-term assumption. So huge progress has been made in the management of the books and keeping our customers with us. It's very, very significant improvement. The second area of improvement has been in the ELM business. We had quite a significant deterioration in the profitability of the ELM business, and we had started selling product through call centres, and we've closed most of those call centres down in the first 6 months, and we've changed the product structure, and that part of the business is looking like it's returning to profitability.
Of course, you do outline 3 focus areas for growth. One of those is addressing persistency and growing sales, and as you say, the persistency is improving. Are you getting new policyholders onto your books, though?
We certainly are. We saw new business, index new business in the retail business down 1.6%, but that has to be seen in the context of the action that was taken in relation to the persistency problem. So, the kind of sales volumes are totally in line with the plan that we had. So as far as we're concerned, we're absolutely on schedule.
Were you worried about the quality of business that you were writing through some of these call centres? Is that why you were closing them down?
Absolutely.
So business that wasn't staying on your book for very long?
Absolutely. So what we found was that the call centres were incentivised on volume, and there wasn't much of an incentive to keep, once the business was written, to keep it on the book. And we saw lapse rates increasing dramatically as a result of the bigger percentage of our business being sold through call centres. So
is it too soon to say whether the quality of business you are writing is better quality than it was previously?
It probably is too soon, Stephen, but we've really shifted the focus of the organisation away from volume and onto quality of business written, and I expect we'll see the benefit of that in the next sort of 12 to 18 months.
Okay, you were also looking at balance sheet and capital management. How's LibFin playing into this? And of course, last year there were derivative structures which did impact on the group quite severely, right?
Yeah, I mean, I think LibFin has obviously been a controversial step that we've taken. It does, other insurers don't seem to have taken the same approach, but we think it is right at the heart of managing this type of a business. We take the view that our job is to originate risk, whether it be market risk or credit risk or liquidity risk or insurance risk, insuring people's lives or insuring them against particular eventualities. And we see LibFin as performing right at the heart of our risk-taking activities in the credit space, in the market risk space, and in the liquidity space. And so last year we had a loss. We took a view that we had to reduce our exposure to market risk. And there are 2 components to that. The one is interest rate risk and the other is equity risk. And we began to de-risk the balance sheet in the latter half of 2008. And we made a profit of R1 billion on the interest rate de-risking. We happened to have a year end in December. We took the equity risk, or started taking the equity risk off in the first half of 2009, and we had a loss on that. But if you look at the overall hedging activities, we've had a profit of 500 million. So not totally unsuccessful.
Of course, you were listening into that interview with Maria Ramos that we did this morning, talking about the consumer still very much under pressure at this stage. Now, you've turned around over the last 6 months, despite the consumer still being very much under pressure. Is this something you can continue into the second half of the year, or does this threat of a double-dip recession really kind of weigh on you at this stage?
Look, I think they're 2 separate things. I think there were some fundamental things in our business which we weren't getting right, which we're now starting to get right. And I think that we'll continue to see an improvement in our lapse experience as a result of the corrective action that we've taken in the business. The global economy is still very, very uncertain. I mean, every day you'll read stuff saying that it's all going in the right direction, and then 5 minutes later you'll see something saying it's going the other direction. So, very, very uncertain. So, the issue of the double dip recession is still there. My view, though, is that things are improving and there is some growth. It's not fantastic growth. It's there. People are recognizing the problems that exist in Europe, for example. People are taking corrective action. So I think, I'd like to think we're through the worst, but the threat of the double dip recession is still out there.
Bruce, Stanlib, assets under management up to 373 billion rand. You've got a new CEO at Stanlib, that's Thabo Dlotty. We've also seen quite a few departures recently, though. Are things starting to stabilize at Stanlib? Are you getting a team in there that is going to be staying there?
Yeah, Stephen, I mean, I'd like to make the point up front. I mean, Stanlib is the third largest asset manager in South Africa. It's got a presence in 7 African countries. It's the biggest unit trust manager in the country. It's got really strong positive flows, despite the fact that we lost a big part of the PIC mandate in the first 6 months. So it's a significant player. In addition to which, we have 55 fund managers, people, actual fund managers. These aren't people who are working in back offices and stuff. There's 650 people employed at Stanlib. There are 55 fund managers. So on any measure, it's a sizable house. We've got a stable team running the balanced money. We've got a stable team in the value space. We've got a stable team in the growth space. We've got a fantastic team in the property space. We've got a really fantastic, stable team in the money market and fixed income space. So there's a lot of things which people tend to ignore about Stanlib, which are really, really positive. So I don't see Stanlib as a problem. I see it as an opportunity. What we needed was to get a really clear mandate from our board to go out there and build a genuine third-party business that was able to take advantage of the opportunities that we have. We also needed to get strong leadership. We've got both of those. So, I'm really optimistic we're going to see a significant turnaround in Stanlib in the next 18 months.